Alright, ladies and gentlemen, happy spring break. You are watching an accounting video right now. Alright. So, what I want to talk about today? Today, we're going to jump right into chapter 11. You guys finish your second midterm, everyone's happy, you're having a good time, and you got to get right back to work. How awesome is that? I'm excited. I hope you're excited. So chapter 11 is actually pretty nice. It builds off of chapter 10. Remember we were talking about favorable versus unfavorable variances? Same thing going on with chapter 11. Chapter 11 just breaks it down a little bit more. Strictly, it's going to break it down between, is our variances price related or is it quantity related? For example, so let's say you have a variance in your direct materials. Did the variance occur because your purchasing manager purchased the goods for too much money, or maybe he got a really good deal? Or was it due to your production manager? Maybe his subordinates maybe wasted too much material as they were producing the product. That's what chapter 11 is going to try and figure out for you. It is exciting stuff. So, for this YouTube video, I'm actually going to walk you through one of the homework problems that you have that's going to be due on the Monday when you guys get back. So, a little bit of a reward for you guys that are watching these YouTube videos during your spring break, right? Homework problem that I'm going to walk through is P11-12. So what I suggest to you guys, in order to get the maximum effect of learning out of this video, is actually read through chapter 11 first, see if you can understand it, give problem 11-12 a shot on your own, and then come back to this video and I'll walk you through it. And that way you can kind of see, did you do everything right? Did you get everything correct? Or are there some areas where you might need to refocus on as you're going through the rest of the problems? So, with that being said, I invite you to pause your YouTube video, and in 3 seconds we'll get back to it and I'll give you a walkthrough. 1, 2, 3, go! Alright, P11-12 is fun stuff, let me tell you. So you got this company, they're producing some stuff, and they want you to figure out where the variances are occurring and whether they're favorable or unfavorable. So as you're going through the reading, you saw that there was things called actual price and standard price and actual quantity and standard quantity. That's all what these calculations are all about. You're going to figure out, was the variance due to a price difference or to a quantity difference? And you're going to multiply those out and compare them against each other and figure out where it's coming from. So with that being said, let's jump right into it. Part 1. For direct materials used in production of Fluidex, compute the price and quantity variances. So to start off this problem, whenever you have one of these types of problems, you're going to start off with 3 different math equations, right? You're going to start off with AQ times AP, then you're going to have AQ times SP, and then you're going to have SQ times SP. Now, from your reading, do you know what those mean? We're talking about the actual quantities and the actual prices, then you got your actual quantity times your standard prices, then you have your standard quantity times your standard prices. Simple enough. And you break it out like that so you can see individually, is the price causing the big variance or is the quantity causing the big variance? So with that being said, for P11-12, for the answers I have AQ times AP of 225,000 and AQ times SP of 240,000. And that's going to give us a difference of 15,000 favorable for our price difference. And then once you have that, you have to compare the quantities, right? So are you going to use that same middle guy, the AQ times SP? No, you're not. Why not? Because there was some 2,500 ounces of material remained in the ending inventory. So we have to account for those, right? So our new AQ times SP is going to be 9,500 times 20. And that's going to give us 190,000. And then SQ times SP is going to be 3,750 times 2.5 times 20 to get 187,500. Make sure you see where I'm getting these numbers from. I'm throwing them at you kind of rapid fire because I'm figuring you already kind of read through this problem, so you're seeing where some of these numbers are coming from. But make sure you see conceptually where I'm getting these numbers from and why I'm calculating them in this order. So you see, for price you had a 15,000 favorable difference. For quantity you're actually going to have a 2,500 unfavorable difference. And that sums up the first part of the question. I think the biggest thing, or one of the most confusing parts about that first part, is where you have that middle equation, the AQ times SP, and it changes from when you're calculating the price versus when you're calculating the quantity. And the reason it changes is because of that 2,500 left over in ending inventory from the previous period. You have to take that out. I think the book does a pretty good job of explaining that, so if that doesn't make sense to you, there's a section in the book. I can actually tell you what page it's on. If you're still having difficulty understanding that, I would reread pages 459 and 460, and that really explains how that ending inventory is accounted for. And to answer question 1 part B, I would say yes, you probably should purchase from this new supplier because the price variance, which was 15,000 favorable, greatly outweighs the 2,500 unfavorable quantity variance. Alright, chugging right along to question number 2. So, how are you going to set it up? Actual quantity times actual price, actual quantity times standard price, and standard quantity times standard price. So, with that being said, I will drop down the correct answers, and you can view them and see if you got the same thing when you were going through it. Notice the big thing here is that you don't have to do that funky little extra calculation with the middle guy, actual quantity times standard price, and that's because with direct labor, you're not going to have an ending inventory of direct labor from the previous period, right? So you see here you have a rate variance of 2,800 favorable and a efficiency variance of 4,375 unfavorable, giving you a total variance of 1,575 unfavorable. So to answer question 2 part B, I would say no, I would not make that recommendation because I would say the favorable labor rate is outweighed by the unfavorable labor efficiency. And then for part 3, it's doing the exact same thing. You guys should be a pro at these calculations by now, so once again, I'm just going to drop those guys in, take a look at them, make sure that you got the same things. If you didn't, try and figure out why. And if you can't figure out why, email me and let me know. Say, hey T-Ball, I couldn't get the answer to P11-12, help me out. And I would be more than happy to walk you through it. So thanks for sticking around and enjoying some Accounting 211 fun. Now, get out of here you crazy fool and go back to enjoying your spring break. I'll see you guys on Monday.